Hello, everybody, and thank you very much for joining today's conversation. Today, we're joined by Carlos, George, and Yves, a pan-European committee, if I shall say so. Yves is based in Austria, Carlos in France, George in London, and then myself in Berlin. Thank you very much for taking the time this morning. We want to talk about crypto in 2022, a review of what happened. Of course, we won't have time to go into everything, but I think two subjects I'm really interested about. Number one is the first drama of 2022, the fall of the stable coins, the algorithmic stable coins, Terra Luna, and talk a little bit about what happened during that situation, and then talk about foul play in crypto. We are undergoing probably one of the biggest scandals of the corporate history, probably even I would include that, FTX. So I want to talk about adverse selection, rug pulls in the space, and essentially find out what it means. Where do we go from here? What do we need to do in the future across all the spectrums of the ecosystem? And we're joined by Yves, Carlos, and George. I'll start maybe by opening the floor to you and saying, hey, give us a quick intro about what you do. George, how about you go first?
Hey, morning guys, excited for this conversation. So I work currently for a hedge fund that's exclusively on-chain. So I'm really looking forward to diving deep into the DeFi component today.
Fantastic. Yves, what about you?
I've been doing private market investments for more than 4 years now. We're a bit more in the later stage, and we've been getting ready, just raising a new fund to do investments in later stage Web3 and cryptocurrencies.
Fantastic. So a bit of a Web3 angle as well in the type of investment you're looking at?
Yes, done that privately, but we will definitely do the first investments next year. Yeah.
Fantastic. And then Carlos.
Well, I've been working with DeFi for traditional finance. Actually, we're trying to get some institutional actors to invest this space, but there's a steep learning curve there, and that's what we're offering as a consulting service at WhatDeFi. At a personal level, I'm also very interested in self-sovereign identity systems and governance systems for DAOs and the like.
Great. So today's panel also brings, I think, two colliding worlds together. George, myself, and Yves have a background in what people call TradFi, so traditional banking, with experience, of course, in the private markets, as Yves is doing right now, but also on regulated capital markets. And I'm quite interested to see what also flavor we can bring to some of the situations there. How about we start speaking about the beginning of the year? We're looking back at February, March, Q1, Q2, and we're looking back at the first thing that never should have happened, which is a stablecoin depegging. Maybe George, you want to kick off with a bit of a look back from your perspective.
Yeah, I can also see Carlos is excited to jump in. So yeah, this will be a juicy topic. I mean, look, just to set the scene for the conversation, I ultimately think that Luna was obviously kind of a disaster waiting to happen, just purely based on the flimsiness of using Terra, the stablecoin, based on the flimsiness of using Luna itself, the native token of their ecosystem, as collateral. And I think I think part of today's discussion is we're going to look more into the concept of digital scarcity. But I think and that draws parallels into other things we were going to look at today, including using FTT, Serum, and other shitcoins as collateral in this scandal, right? So I think stable coins are absolutely fascinating as the kind of the gateway bridging on-chain and off-chain. And I think in some respects healthy to have some failed experiments. I think that kind of what happened with Luna kind of just goes to show that there's kind of real interesting problems to be solved. I mean, there's something kind of known as informally as the stablecoin trilemma, but people are trying to figure out what's the best way to have kind of decentralized, basically secure stablecoins, right? Whether they be fully collateralized, over collateralized, You see things like DAI, which obviously have held up very well, and things that are over collateralized on chain, and things like USDC, which are centralized, but obviously function completely in a regulated way. So I think that it will be interesting things. I mean, there's new things. It's part of a whole other podcast, I think. But there's things like Frax, new interesting innovations happening in the stablecoin space. So I think that's fascinating. So we're gonna see how things evolve. But I think what happened in the Luna case was clearly a case of just very, very optimistic risk taking. And there's definitely we understand that. There's a kind of a Ponzi element to many DeFi protocols, right? And I think that was clear in the Luna case. I mean, the yields that they were offering on their anchor protocol were clearly unsustainable, trying to draw new capital into their ecosystem. Just to kind of wrap up this point, I think there was a recent tweet by one of these investigative kind of Twitter reporters who figured out actually the first trade that actually started the Luna death spiral was actually a 400 million sale by Terraform Labs themselves. So I think that just goes to show how kind of flimsy a lot of these kind of digital scarcity kind of assets really can be.
Super interesting. So, Carlos, you thought you had some thoughts around that as well.
Yes, one of the most important words that George used right here is the word risk. Because of the youth of all this space, specifically DeFi even more than others, stablecoins and DeFi are even more recent than the blockchain space. All members, whether they realize it or not, have an appetite for risk that is above average for the normal population. So seen from the outside, we're having behaviors that are high risk. Even when we think it's rational, people that are not involved with activities in this space will think, of course, this was going to happen. This was bound to happen, couldn't happen any other way. Risk is the reason why regulation exists in the banking system, to avoid the retail customers and other clients of the banking system to suffer from all the risky decisions made by financial institutions managing their capital, their investments. And right now we do not have that in our space, and we'll get into it first. Specifically concerning Terra Luna, I like very much the concept of stablecoins that do not have algorithmic stablecoins as a concept. When I first read about it, I was very excited, basically. I was thinking, okay, this might be the way to finally have a currency that can be used because it's not volatile and it's still not using any reserves from fiat currencies or from any other asset that is normally traded. It's completely crypto native. Well, George probably is aware of more projects in this space than I am. Up to now, I haven't seen any that actually works, but I was only made aware of that with the fall of Terra Luna. And as mentioned, that sale that started the entire fall of the Castle of Cards, sorry, that sale of was it Bitcoin? I think can't remember. There was a trade with Bitcoin in there somewhere that provoked all of this catastrophe, is actually the seed for what we're living today with FTX, because their exposure to these assets provoked issues, and them trying to save other entities in the DeFi world and DeFi space, and just starting to buy outright other companies didn't help. And the fact that they had absolutely no controls on their own corporate structure, no compliance unit, operating compliance unit in their own structure, obviously led us to where we are today. But this, once again, is just optimistic analysis of very high risks. And when you leverage your investments, when you over leverage your investments with smart contracts, and you don't have more collateral to put into them, and when a certain threshold of conditions is met, they self execute. Well, we're going to see this again. It's not finished. We're going to see it, and this all comes down to people, the way they behave, and the realization that we behave in the DeFi space exactly like everybody else behaves in other financial spaces. In the end, we're all just humans, so there's no difference there. And the need for regulation doesn't come because DeFi or cryptocurrencies or the blockchain world is completely new and astounding and different. The need for regulation comes because the actors in that space are the same people that need regulation in other spaces.
So a combination between overzealous risk-taking, lack of regulation, and then also from George's point, poor designs. Maybe
Yes.
you mentioned, Carlos, young people. I see also, the pressure and the growth pace, also was not a conduit for, really thought out designs and processes. And sometimes things just became, so successful that they could not change, the protocols. I look at USDT.
And I would even say that if you are very successful very early, you do not even realize, or if you do, you might minimize the risks you're taking, because up to now that behavior has only brought success. So why would it bring a catastrophic final like we're assisting now? It's from a human standpoint, it's all understandable behavior,
Yeah.
but some of it was outright fraudulent.
We'll get to that shortly, but I think, and Yves, I want to hear your thoughts around algorithmic stable coins, and also as you're now a private investor, also a bit of your perspective when you do due diligence about specific projects, what you sort of think about, how you look into these things.
Yeah, we had a lot of conversations about that at the beginning of the year, because we sit in an ecosystem here where we have a lot of early stage investors, and a lot of them had exposure to Terra Luna. And the discussions around that were always kind of the same, right? It's like you have to have had exposure there, but it was sort of limited because all of them had institutional investors in their backend. So you have to explain to them, well, we are going to take risks, calculated risks, and Terra Luna was something that was seen as stable, right? There were some discussions. I mean, I saw some little stories cropping up of how you could have predicted it, but correct me if I'm wrong, but I think everyone was surprised when it happened, right?
Oh yeah.
And so then when the news broke and it happened, the discussions we had were about explaining to people how something that was supposed to be stable and supposed to be, basically non-changing in value, that was supposed to be just a ramp or a tool to be used, more or less, would suddenly collapse. So you had to educate people more, and we had a pipeline, so to speak, of things that we were going to invest, and that completely collapsed. Right, the conversations completely switched because it was like, wow, risk off. How can this happen? This is would never happen in the TradFi space. And then you have to shift the conversation, and the conversation becomes way more broad and becomes kind of like what Carlos said. These risks are taken in all kinds of in TradFi as well, and you have situations like this in TradFi as well. But it takes a lot of educating people because of the exposure that the space gets right now. There's a lot more finger pointing, right, and say like, this should not be happening like that. So the way we approached it and we looked at it is, yes, it's a young space. Mistakes will be made, and in a way, we want to have that risk because it's supposed to be rewarded accurately, and things like this are going to happen. I think it just takes educating people in the back, especially more traditional, more institutional investors, if that's what you have on board. And on the private side, if you're dealing with larger investment vehicles, That's what you're going to have. And I think for the space as a whole, it's important to keep educating people and keep on-ramping people, right? And not be discouraged by these events.
100%.
That's the way we approach this.
Super interesting. You mentioned there's 2 points I want to pick up on. Number one is opportunities that this creates, which is, I believe you kind of insinuate that, right? It's about selection of the right assets in your space and the due diligence. So the active selection of looking into the protocols, right? And when, explaining and doing a lot of that work. Maybe explain a little bit around that. And then the other thing you mentioned, which I thought was interesting, is how Terra Luna maybe was for you something that put everything on hold, right? And it also, on the wider crypto market, was the beginning of the crypto winter, and so to say. And then we saw all assets kind of melt away from there, really accelerating. Just a bit of color around that.
Yeah, starting with the second point you made, actually, that comes from the dynamic you have when you have investors in a fund that you have regular conversations with, that you have reporting sessions on a quarterly or a monthly basis with. When something like that happens, your phone is going to start ringing, and people are going to want to ask questions, even if the exposure to what happened is very limited. Every new investment afterwards you're going to propose and you're going to want to make, you have to run it by your investors. They usually have at least they are informed about investments. And of course you have conversations with them about the strategy going forward. And so if something like that happens, especially with the media attention it got, and especially with the broad sort of market fall off almost that happened in the following weeks, there was a sentiment where it got very hard to justify an immediate investment in that space, right?
It's quite interesting, because I think we were thinking internally on our end, we were quite counter-cyclical. We were actually quite happy that it happened, because it demonstrated, okay, crypto is not only about successes, and it started feeling very bubbly, right? The market at that time, and nothing could fail. And then seeing Terra Luna fail kind of gave us, okay, a healthy sign for us. And we actually became quite positive on Ethereum as we dropped from 2K in the low 1000s. And not because we're investors, but because we build on Ethereum and we need to have some exposure for the smart contract. So we use that opportunity to snap up and gain exposure to then continue building. But we liked it. Was there something like this? And also George or Carlos, looking at everything going on, I saw it as an actual positive.
Maybe just to finish. Sorry, Carlos. Just to finish the point from the side, how we thought about it. Yes, there is that sentiment, but that's starting, I would say, now. So we're raising a new fund now to sort of take that momentum in. But what we wanted to see first is have the ride or the wave ride out, so to speak, right? Not jump in too early. Maybe our investment cycles are a bit longer and a bit slower, coming from a private investor space. So yes, there's definitely that sentiment. It just took a while longer, and it just took a bit more maybe explaining and conversations to be had to get to that stage. Because, and that will finish my point, if you look at the exit multiples that were realized, they're always the highest after a market downturn. So we see this absolutely as an opportunity, and we see this time as the time to invest, for sure.
Carlos, did you want to add something around that?
Yeah, I was just going to say that optimism for some fringes of the market will be a bit too much, but definitely bursting the bubble. And it's still all of this ripple effects from Terra Luna debacle, all that we're living now. It all started there. But from people with your backgrounds, you could see that offering return on investments that are 5 to sometimes 10 times the rate of inflation of markets, is definitely not sustainable. This can't go on forever. Someone is going to have to pay for those returns to be awarded to others. And this is something that happens in all financial markets, not just in DeFi or just in crypto. In any speculative market, when the bubble bursts, the last ones to invest, that's when you see people that went to swim naked when the tide pulls back. And this is what's happened. This is not an uncommon cycle. Once again, in other spaces, and people know how to deal with this. Is just the alarmism around all this space and the media focus on this because of the threats it poses to already to incumbent players that make all of this seem like catastrophes. They're not. At the same time that all this was happening, Ethereum managed something akin to changing the four engines in an airplane during flight. The merge happened. It's a huge technical feat. All other building processes were kept working. People are still developing new projects, new ideas in many different areas, and these are growth pains. We're learning, and what happens too is that we're getting more professional. It's less enthusiasm in how we do things, and less, oh, this guy is so smart, let's follow him. And we're starting to say, okay, you're saying that, but why are you saying that? Why do we need to know all of a sudden that a certain star or influencer is supporting a project? From the go, that starts to smell dodgy. People are now a bit more attentive to all the red flags that this kind of projects bring along with them. So I think, yes, as Yves said, there's reasons to be happy about this, and you too. One of them being that now people can actually buy Ethereum and pay gas fees, and it was a bit complicated before that. So that was just my 2 cents.
100%. So what we saw, Terra Luna, kind of the first crypto meltdown, but actually a little bit of optimism, constructive optimism for what it means long term. I think my key takeaway was the NFT market actually absorbing quite a lot of this shock, and NFTs were doing fine. The OK Bears, one of our colleagues at Yodel, he bought or minted an OK Bear. He was doing great. He was loving it. A bit of that absorption, and then also a fading of that very quickly, as we saw global, all asset prices kind of drop right across, and then
low tide.
But I was still constructive. I still, and then for me the big shock was FTX headlines, because it was so unexpected. Because we couldn't predict, first of all, we don't like keeping our stuff on exchanges. That's why it's not an issue for us specifically. I think that's the first part of education that also we need to explain to people is, what type of architecture you use. Do you use wallets that are decentralized? And George will speak about DeFi. What does it mean to keep a DeFi, truly implement DeFi on your backend or your systems versus working with an FTX? But for me, that was the big shock that initially scared me a lot, but then also when the news flow kind of hit, okay, it is clearly fraud, it seems, and as he speaks more and more, I kind of felt relieved and still, can sleep at night and thinking, okay, Web3 is going to be fine. But yeah, let's talk about FTX. Let's talk about repercussions, because it was, I felt. What's your thoughts? Yeah, George, Yves, Carlos, what do you guys think?
Hey guys, cool, interesting discussion so far. Let me just jump in on a few things. So I think, first of all, look, yeah, DeFi is absolutely going to be fine, right? So despite everything we've discussed, DeFi is absolutely going to be fine. I think that, look, in many ways, there's 2 ways to look at it, right? In many ways, Sami said he was happy that some of these blow-ups happened. And I think, look, I think that's a fair perspective. I think, flushing out the bad actors, I think is obviously necessary. I also think that, to be honest, I think it probably is a good thing in as far as people who are really interested in the space are able to create kind of a nuanced understanding of what DeFi can and can't do, right? Because I think there was a time when everybody got caught up in the hype and everything was going to be tokenized and the whole world was going to be changed. And I think that now people have kind of understood, okay, look, there's real interesting innovations happening here, and specifically on DeFi, which is where I look, right? There's really, really interesting innovations, and it's not gonna happen. Like, we came too far too fast, right? Everything's not gonna suddenly change overnight. But I do think, people have been talking about asset tokenization for ages, but it's becoming real, and DeFi is starting to touch the real world. So initially DeFi is only being used to trade crypto, but then so we start seeing stable coins. Okay, you can do a stablecoin swap from USDC to a euro or yen stablecoin, right? And then maybe potentially that's the fastest way and most efficient way to transfer millions or potentially hundreds of millions or even billions of dollars, with the lowest possible fees, right? Then there's people looking at there's already kind of CDeFi, right, which is kind of on-chain lending. Typically, it's been used for crypto market makers like Alameda. So you might not want to be doing that. But then people are starting to look at things like on-chain credit, and people are starting to look at things like SME lending on-chain, right? And then suddenly that becomes interesting, right? Because that's something that can be used as real collateral, not some kind of token that you've issued yourself and lent out to a few of your friends, but that's something that's substantial collateral. And then suddenly you're kind of rehypothecating those assets, and then there's blockchains are programmable, right? So there's very, very interesting other kind of smart contract logic you can use to make these things more useful, right? You can create automated market makers. Things like Uniswap exist, right, which are for trading tokenized assets, right? So a lot of interesting innovations. We can talk about DeFi protocols all day long, but I think that people who are close to the space understand the innovations, right? So I think that I think everything gets flushed out. I think it's very easy for people who need a very simple approximation, who think, I understand why people think crypto is going to zero, because if you need the simple first order approximation, the majority of tokens are potentially probably worth zero, right? I mean, the vast majority. I think there's however many tens of thousands on coin market cap. I'm not sure exactly, but potentially most of them are worth zero, right? So I think that's a fair enough first order approximation if some people want to make it. But they do encourage, for potentially anyone watching this, I do encourage people to, if you're not already in DeFi, to just kind of get close to it, create a wallet, start trading, and get involved. And then I think that's probably the best way to kind of see the innovation that's taking place.
And I'll ask you a few questions around yields. Because Carlos mentioned, when you don't know where the yield is coming from, it's probably you or the other guy. We've seen a lot of these projects, but actually there's also a science behind it. There's true, financial markets principles that you can apply, and we maybe actually let's jump right into it. How in very basic terms, some products offer you yield. How do you achieve yield in DeFi?
Yeah, well, it's a great question. I think understanding what's sustainable and what isn't. So first of all, the first thing to note is yields in traditional finance are going up. I think now probably the Fed funds rate, and you could probably buy a 1 year Fed Treasury bill for 4.5%, I believe, right? So, I think when stable coins were earning you 6%, it's not as crazy anymore. So I think first of all, and yields in DeFi coming down, right? Because organic volume, like genuine yields are coming down because organic volume is coming down, right? Not many people are trading on DeFi, so it's harder for you to collect fees and there's not much. The demand for leverage is down as well, right? So the on-chain lending markets yields are becoming compressed. So any yields you make from lending or trading fees are going to be reduced. But look, we're talking genuine sustainable yields, which are not Ponzi yields. So for example, I mostly look at Uniswap, which is the largest trading protocol on DeFi. So they'll do about let's call it 3 billion a week in trading volume, and I think over a long period of time, averaging Uniswap fees is about 2.5 million a day. Right now we're below 1 million as of the last 24 hours. So I think my goal is to kind of look and see the best way to collect kind of trading fees on Uniswap, right?
And so that's an incentive provided by the DeFi protocol for you to provide liquidity to them. And then,
that's correct.
Yeah.
Yeah, that's correct. Yes, excuse me. I should have explained that. Well.
No.
No, absolutely. I think it's equivalent to being a broker in traditional finance, right?
So there is some sort of bid offer. You provide the liquidity. You hedge yourself using other instruments, and then the difference you keep. And the idea being here that you want to stay risk neutral, because if there's a big event, what they call a gamma event, right, that's going to squeeze you left or right, so market goes up very quickly or down very quickly, you need to be hedged so that you're not taken out. But whilst the market is regularly functioning, you can collect these little fees for providing that liquidity, and that's ultimately where the yield should be coming from, if you're thinking about that part. Yves, how do you think about yield in crypto? Where should it come from? And you have maybe a more holistic view because you're also investing in different types of projects.
Yes, so I take a very general view on that, is that I want to know where it comes from. That's right, and it has to be well, understandable. I have to understand where it comes from, and it has to be sustainable, right? There has to be some sort of schedule of where it's going, or a plan, or and that has to be transparent. And for some projects, it's just a question of they have to know where it's going, right? Because sometimes you see like, well, it's high now, but will come down eventually, but don't know when or how. So I look at yield in that way, and it's I have to say it is difficult, right? It's difficult to keep yourself to that in that framework where you go, if it's too high, it's probably not sustainable. Because if you see people for months and years collecting what you consider oversized yields, it's very tough not to jump in, and you see a lot of people jumping in.
Yeah, it's tough.
It's tough, right? It's tough to sit on the sideline when everybody's making a lot of money, and you think
appetite for risk.
Yeah, exactly.
And maybe that brings me to one of my biggest questions. Okay, we had like difficulties in the market, but everything was kind of working. It made sense and logic, and then EFTX happened, and that's the irrational side of the market. It's the greed, it's the frauds, at least alleged frauds. We don't know exactly yet. But behind that, there was institutional money, right? These guys were speaking not only with the regulators, but also with CME. They were speaking with VCs. How could this happen should have happened in the first place? Maybe Carlos, you want to give us a bit of flavor for what you were thinking at that when you saw it unwind.
Well, yes, basically from what I've gathered this past month, everybody skipped due diligence on this affair. So there were red flags for those that were looking for them. Little disclosure, I wasn't looking for anything because I've never even traded anything close to FTX, but that's not a reason for others not to look at it. So there were red flags. VCs definitely should have spotted them. People that were putting hundreds of millions on this company should have spotted everything, including the fact that there were no compliance mechanisms, internal compliance mechanisms in a structure that in January this year was worth $32 billion and is now worth zero. There's something very, very wrong here. So why did they invest if they didn't do this due diligence? One, the man, Sam Bankman-Fried, had a very good public image and public presence. He managed to work out very well that altruism side of it. Effective altruism, was it? I don't know. And with both parents being compliance professionals and professors, people were thinking, okay, this is somehow ingrained. This might have been one part of the explanation, that the man just sold himself as someone that was close to legislators that wanted to regulate markets. And so nobody thought of looking behind that and see what he was actually doing and not saying. That might have been something. And the rewards were coming in, at least on paper. So, as Yves just said, we all have this situation, this appetite for risk. We see these rewards coming in what seems to be a sustainable manner, and we think, oh, by being overly conservative, overly cautious, I'm missing out on this stuff, and we jump in.
Yeah. So fear of missing out,
Yes,
essentially.
except they were doing exactly the same thing themselves, and they were using capital that wasn't theirs because they didn't want to miss out on anything. So these are all human behaviors. They have nothing to do with finance mechanisms. It's just that we jumped over all the safety guards that we've been building in more professionalized and more traditional finance, and we just went for it. And when it exploded, obviously, it's a very big fan, and everybody gets splattered after something like this, and it will reach wide and fine the corners of all financial activity in the space.
I think it's super interesting because so a really long time ago, one of my first internships was in something called Sarbanes-Oxley auditing. So, SOX, and if you know, and these are kind of industry wide, I would say, principles of business good conduct. What you need to do in coming after Enron, of course, how you essentially run a publicly listed or just a company, right? So there's these kind of principles, and I think a lot of people overlooked that, right? And thought, okay, I can just set up a business in the Bahamas, in the Virgin Islands, and just ignore anything else, and then operate freely in the US or any other market linked in, and make abstraction of that. So I think there's a misconception, right? The lack of regulation for crypto doesn't mean you can do anything anyways, right? For example, I'll give you a very vague example. Is it, if I do an NFT project in Germany and I'm listing it on OpenSea or anything like that, and I'm trying to reach, let's say, 5,000 people, am I fundraising? Do I need to get BaFin approval? Because I'm essentially raising an investment product, or is it just the art? Like but as soon as you enter these type of things, you need to be careful internally and have your risk assessment and your checklists and say, hey, and there needs to be another person that is independent that watches you, right? A compliance function, an oversight function. And I think
from that, sorry, Sami.
No.
From that standpoint, you look at who is auditing FTX or other projects in this field, and you'll notice that there are 4 entities that are absent, and right now there's 4 of them, but in 2008 there were 5, and 1 disappeared. And why did it disappear? Because Enron happened and they were auditing them. So when you talk about the big 4 in auditing right now, they all have a name and a public image and a reputation in the market. And when a corporation, when a company comes and says, I'm audited by one of these 4 companies, people take them seriously because these companies built their reputations on providing a good service. Except when it didn't happen with Enron.
Or I will caveat Wirecard. I think,
or Wirecard, which is the same kind of thing. So Enron was Arthur Andersen. They no longer exist, so we can talk about them. Gone, been flushed out. All the professionals that worked there are still employed in the business, though. So all the type of decisions that were made at that time can still be made. But when we're talking about FTX and crypto-oriented projects, these companies don't touch them with a pole if they can avoid it. Okay? We're seeing second layer companies auditing this stuff, and what they're doing, and you guys know a lot more about this stuff than I do. First of all, FTX and other projects like FTX are clients for these auditors, so they're paying, and they're paying big money. So auditing reports are always a delicate situation for any auditor, always. And what they're saying is, from what we have seen in this situation, this seems to be all right. What is a lot more important is what are auditors not saying. And in the FTX case, I suppose that if we read all their auditing reports, there will be a couple of issues that should have been mentioned and weren't. We'll see in the future, because all this will become public sooner or later.
But FTX famously didn't have, I mean, they had an auditor, but he was based in the metaverse. I think on Decentraland. It was in their bankruptcy filing. I mean,
exactly.
It's probably not the one you want to go for.
Of course not. But they had one. See, they had to have one for anyone to believe they were a viable business option. Except, obviously, if you have one whose address is on the metaverse. Start with, you haven't even defined what the metaverse is, and the address of your auditor is in the metaverse.
So interesting how that all played out. And to summarize, lack of oversight, so lack of compliance, overzealous risk taking. You mentioned it, too young, maybe too much, right? Running, these guys are quite young, and I'm not saying that young people can't run, multi-billion businesses.
Yeah,
but
no, that's not the point.
There is an element of, well, clearly in hindsight, these were probably not the guys, not necessarily because they don't know how to do it, but because they failed to hire the right people to make sure that it works.
Yeah, Sami, more than saying just that they were young, is the space in itself is young. Sam Bankman-Fried was young, but he came from a trading company. He was quant trading before. He knew perfectly well what he was doing. We'll see how legal evaluation of all this situation turns out. But it is difficult for him, when talking to other professionals, to say, I didn't know that I couldn't mix customers' assets with my own. He can't say that. He's an MIT grad. He was working in prestigious companies in this space. Of course he knew that. To the public at large, he went from the genius guy in the finance, in the crypto finance world, to, oh, I'm just a kid, I'm just 30 years old, too much success, I didn't know. That's PR. That has nothing to do with what's happening in our models to deal with finance. But it's something we're going to have to deal with, because the space is built of actors, and actors are humans, and humans do have this kind of behavior, and we'll just have to learn to deal with that stuff. That's all.
Interesting. Yves.
One thing that jumped out to me is, he was in a trading firm before, and I recently read the comparison there that, well, he had risk limits there, right? And then when he switched and opened his own shop, maybe that played into it, that all of a sudden there were no risk limits, right? It was just an open playing field, and he could do whatever he wanted, and it was up to himself to define his risk limits. And he probably just wasn't up to the task of properly defining that, or just having them at all.
Just one observation, Yves, very quick. He did define risks for all their clients, with one notable exception. Just one.
Himself,
Alameda Research.
Yeah.
That's it.
Yeah.
My feeling when I was reading all of this is he and the company's DNA. How did he make his money in the first place? By arbitrage. Right, that was the core competence, the USP, because I look at it from a pitch perspective, right? What's my USP? Well, arbitrage. And then the pivot that they made to then being a customer-facing business with custody was essentially not fitting the company culture, not the DNA of the people, that's the type of things they wanted to do. They wanted to remain a prop shop, I believe, is my 2 cents on that. But maybe to put FTX behind us, because I think we all agree it has nothing really to do with crypto. It has impact on crypto because there's assets that have been misplaced and will have an impact obviously also on all the companies that were invested in, 130 I believe. But again, I think 2 weeks ago I was a lot more depressed about this and thought, okay, now credibility is completely gone. But can we look beyond this? Has this put us maybe 5 years behind on the curve? Where do we go from here? What do we need to change to get the non-crypto guys also into Web3, I guess?
Hey, Sami. Can I just jump in on that one? Look, I think that personally, I don't see it putting anyone 5 years behind. That tends to be that tends to be the common narrative. I personally think could be a bit of an accelerator for the space, actually. So I think, first of all, the DeFi narrative is strong, which is, for me, what this technology has always been about. The exchanges, the word exchange is also a misnomer. I know FTX were trying to be everything. They were trying to be a broker. They were trying to be an exchange. They were trying to be the New York Stock Exchange and Goldman Sachs and the clearinghouse and, a front end for DeFi, right? So the truth is, this thing has always been about DeFi. It's always been about technology. It's always been about the interesting innovations that software engineers, smart contract developers are doing, right, to essentially make the financial system more efficient, right? So I think that's what it's always been about, and I think this could be an accelerator, because whatever regulated on-ramps you have to go from off-chain to on-chain, I think those are just going to be made more transparent and kind of brought to the surface, right, and made more clear. And so the rules about what can and can't happen are going to be made more clear. I think with something we haven't mentioned today, so I'm very focused on understanding the amount of leverage that's being flushed out of the system at the moment. And I think a lot of things that we haven't discussed are what's happened to all the lenders, which, the BlockFis, the Celsius, the Genesis, all have slightly different business model, but ultimately it's lending to each other. And when you're in a bull market, the demand for leverage is high, and that's part of the reason why we came too far too fast. I'm looking forward to seeing how this gets flushed out. We mentioned as a final point, we mentioned how kind of resilient in some respects, not in others, but in some respects, the traditional financial markets are, and a lot of that, despite kind of the existence of a fractional reserve banking system, despite credit creation, despite leverage in many parts of the banking and shadow banking system, there's still rules, right? There's, banks themselves, for example. So Sami and I are credit traders, right? So we understand leverage very well. In our previous jobs, and I think there's looking at financials, for example, right? There's very strict credit ratios that they need to have. They've got capital requirements. They've got pillar 1, pillar 2. They have all these things that they have to abide by. And I think I just think it's just funny to me that you can have a huge amount of lending going on without some kind of transparency on these kind of ratios, right? Before people start putting their money into these kind of systems, right? So and that's just as a final point. I think that people understand why that's the beauty of DeFi. Right? Everything's visible on chain. You know exactly how much collateral there is and the mechanism and the token design. So over to you guys, what you think.
Just one observation there. The reaction to all this debacle has been the proof of reserve concept, and we'll probably evolve that into something akin to a proof of solvency one that will be on chain for decentralized finance projects. So you will know in real time what is happening with the project you're putting your money on. Banking systems have evolved through regulation. They are obviously a lot more agile in lobbying regulators than anyone in the DeFi and crypto spaces. That makes sense. They've existed for a lot longer. But within weeks, this concept that probably was already floating around but was definitely not popular became something that everyone needed to address. I think Kraken was doing it before the others already, the proof of reserves. But now what we're going to see is, okay, you prove you have these reserves because your wallets are public and you disclose what are your wallets. Next step is we need to know your liabilities, and all your lenders like Gemini and BlockFi and company that probably are suffering the effects of the low tide and swimming with no trunks on. That situation in the future will become a lot more transparent in the DeFi space. And simultaneously, and because we haven't been talking about this stuff today because there's just no time to talk about everything, we're all in Europe. George is in London, but it's still a market that has to abide by relatively similar regulations. And market in crypto assets regulation is coming into line and will bring some transparency to a significant part of crypto asset trading and projects. And next round of it is already being talked about and will address specifically DeFi and NFTs. And I am very curious to see how that one is going to happen because of the very nature of specifically DeFi, where there's no centralized and liable entity. If we're going to keep talking about, as the Americans did, okay, you wrote a software, you wrote a protocol, you wrote Tornado Cash, so you are a criminal, we're going to detain you. I would like to see if that's going to happen with DeFi or not. I would hope not, because writing a tool doesn't make you a criminal. The way you use things makes you or not criminals. And so I will be
And
interested
for
in
anyone
how...
who don't know, Tornado Cash was a thing where
Oh,
you
yes.
just put in money and then it would automatically make it difficult to find out. So essentially, money
It's a
laundering.
mixer.
It's a mixer. It's a tool that was used to hide the origin of monies.
Exactly.
So yeah, the question there being, is it the person who made it, designed it, or the actors, right? So regulation will have to kind of make also clear what rules, right? And then we will all know also. But I personally, I'm a strong believer in ethics in the first place. I think if you do good business and if you adopt, let's say, like in the best case scenario, right, for FTX was to go out and before doing anything, hiring a bunch of people from TradFi with experience into building exchanges, right? Because they wanted to essentially build a centralized exchange for crypto and leverage that expertise and knowledge, right? But they haven't. And I think there is a lot that, and if you behave already like a good actor, you will get rewarded truly. And I think that's what they were trying to play at by going out and, speaking to regulators and being in front of Congress. They were trying to do that, but they were trying it. Now we understand why they were doing that, because something was in the workings of working against, well, they had to hide something. But I still believe that you need to be a good actor, build a solid business, and that will attract capital from investors, institutional investors, and then also your customers. That's when you're going to be really successful in the next, in the next bull market, so to say. Yves, how about some comments from you?
Yes, that's why I'm actually excited about this whole thing now as well. I would agree, Sami. I said it felt a bit more bleak a few weeks ago, right? But now I think with some perspective and a bit more adjusted and the situation is becoming more clear, I agree with you guys, George and Carlos, that it's exciting actually. The bad actors are going to get flushed out. And the way I think about it is the ones that thrive and survive this situation and thrive afterwards will have been battle-proofed once more, right? So then you will have one more sort of proof, one more medal on your lap, if you want, and builds more trust that you can then use. So I see this as a positive development, if you want. Sami, you mentioned earlier a bit the deleveraging, the valuations coming down. We see this as part of the larger what's happening in the tech space in general, right? Which kind of coincided. And there will be the next bull market, right? That is going to come for sure. So yeah, I see this now actually quite excited about the years and months ahead, I would say.
So Yves, are you guys looking? So next year is the year for you guys to really look into opportunities. You said you raised the fund as well.
Yes.
So
but we will do that, and that's the thing, right? We look at a bit later stage, more mature, so has to have a stable model, let's say, right? And that's why I think this is exciting in a way, because it flushes out the ones that don't have don't have a stable business, that are just built on easily available cash, that were over levered, that raised at valuations that were too high, that they might need to have had restrictive terms to get them. So all of this, when the water goes down, you will see, and it will show. Yeah, and it will take a few more months for it to all play out, I think. But then the case for investments will be even stronger, and that's why we look at it in a positive way.
Fantastic, super. With that, we've explored only the surface of what could be a probably 3 to 5 hour conversation. But I want to thank everyone for giving a bit of insight into how you think about crypto in 2022 after all the hardship we had, the situations, and how you're going into 23. So thank you very much, Carlos, Yves, and George, our Pan-European committee. Thank you so much for taking the time today. And I'll hope to have more conversations with you about these situations and also about certain things we talked about, like the yields, for example, with George. I'd love to have a deep dive with you guys. Thank you.
Thank you.
Thanks, Sami.
Thank you.